Good morning, everybody. Hope the week is treating you extremely well. In this video, we're going to do things a little bit differently. We are going to take a look at the technical side of things on the S&P 500 and the other major U.S. indexes, but we're also going to talk about some fundamental and some economics as well, which is something we usually don't do in these videos. But before we get to that, and it's going to be very interesting to take a look on that front, let's talk about the technical side of things. So the S&P 500 has clearly broken out over the resistance zone where we broke down from last year. This was this major zone, this 2820 on the S&P 500 that we have been talking about now for pretty much the entire year is the zone to pay attention to. We have cleanly gotten over that. Market continues to make new highs of the year. In this week, gapping up strongly and continuing to push higher. And we finally have all of our moving averages, the 10, over the 20, over the 50, over the 200-day moving average, and they are all pointing to the upside. So they are all aligned properly, and that is a very bullish technical signal. The last time that we have seen that alignment was back in here last year, and we saw about a 6% rise out of the S&P 500 over the next couple of months once we got all of those moving averages aligned properly. So all of those components are lined up and look extremely bullish. And this should bring us into the economic and fundamental side of things. Some people are very perplexed here because if we take a look at the economic and fundamental data that has come out here over the last couple of weeks and over the last month, it has been resoundingly negative. We've got the yield curve that's inverted. We've got GDP revisions lower. We've got misses, not just in the U.S., but global-wide on earnings, where companies have guided lower, citing lower demand, tougher economic conditions globally from major U.S. players and companies abroad. And then we have a number of economic surprises underneath of the surface as well, when you're talking about employment change numbers, durable goods orders, retail sales. All of the economic data points that continue to come out have been very much on the negative side of their expectations, and yet the market continues to rise. Well, it takes us back to one of the old adages, which is Wall Street climbs a wall of worry. And what that essentially is saying is in bull markets, good news is good news, and bad news is good news. And that is the activity and the behavior that we have had over the last few weeks. And in fact, over at Sentiment Trader, they actually quantified this. Citigroup puts together their economic surprise index, and we can see that it has been resoundingly negative for the entire year, dropping below 50% for the first time since 2017. Now, this has some negative connotations here for the overall market, but more so the actual U.S. dollar. So let's look at those numbers. So when we drop below the 50% on this index for the first time in 6 months over the last 15 or so years, what you'll see is that the S&P 500 is positive 40% of the time about a week later. And then after that, it's pretty much a coin flip. 50-50, 2 weeks, slightly biased to the upside. But again, the market pretty much always has a slight bias to the upside. At 1 month and 2 months, 3 months later, it's only positive 60% of the time. The risk to reward is about even. Essentially, this is not a good indication of where the S&P 500 is going to go. But it is a good indication of where the U.S. dollar will go when we take a look back. Percentage of the time positive, 1 week later the dollar is positive 40% of the time. We go out 2 months, 3 months, 6 months later, only 10% of the time. And the risk to the downside is closing in on that 3% mark, 2 to 6 months out. And that has an impact on other things that are obviously priced in the U.S. dollar. One of the things I'd like to take a look at here is gold. All right, gold is actually up sharply over that 1 to 3 month zone in here, with it positive almost 70, 80, and 90% of the time respectively, with some pretty large moves in there. You can see at the 3 month mark, gold on average up 11%. So that is very interesting, and that's going to be something that we're going to want to pay attention to, is what the U.S. dollar does here with all of this negative news moving forward. Let's go ahead and clean this, and let's back things out here, and let's take a look. So the U.S. dollar, I'm going to back this up, and I'm actually going to look at this in on a weekly time frame, right, is right at resistance, okay? It is right in this zone that has been important going back to 2016. It's right here at this like 97.50 zone, right? This is what's going to be very, very important here moving forward. And we do have an ascending triangle pattern, so we have made higher lows, but we have not made our breakout yet. And when we look at that study, on the fundamental and economic side of things, the U.S. dollar should have some issue right here. If it does and makes that rollover, we would want to be taking a look at those precious metals and miners. Again, that is if it makes that breakout. So we're going to be paying very close attention to what the U.S. dollar is doing here with that study. Now, coming back, and let's get back to the S&P 500, and let's talk about what the worst case scenario right now is really for the bulls. And we'll take a look at two different ways of looking at this. So we have broken above this resistance zone right here, and that puts the next resistance zone here at that all-time high zone. And we are not far away from it, right? About 2.5% or so from making those all-time highs. What the bulls don't want to see happen here is a run right up into that resistance zone, and then of course a turn back. That would put in a almost a year-long double top. That would be the concern that the bulls should have right here. And since we're speaking about theoretically how markets work today, we'll talk about one of the other things that could happen up here, and that is the false breakout. And I'll explain why false breakouts happen from a theoretical standpoint. So if I have a large number of shares to sell, if I just go to the market and I sell them, oftentimes I can move the market down on myself, right? If there's not enough buyers at a particular level and I want to get out of a position, that causes the problem of if I start selling, price is going to continue to go lower and I'm going to get less for my shares than I want. So large institutions and large traders will pay attention to levels where lots of orders are sitting at. And there's one glaringly obvious zone right here that we have a ton of orders sitting at, and that is that all-time high zone. If you have been short and you are shorting up in this zone here, your stop is going to be somewhere around that high of the year, maybe a little bit above it, right? That's where you would, as a bear, throw in the towel, so to speak. If there are a ton of orders that are sitting up here, right, and you have a large position as an institution, you can see those sitting out there. What they will do is they will break it through resistance, and when you break through resistance, you now have all of these covering orders from the shorts, which are buy orders. Now I can turn around and sell my stock into these people right here. And once the shorts are done covering and once the institutions are done unloading their shares, so to speak, the buying pressure dries up and the stock falls right back down underneath of that resistance zone. That is really what happens under the surface when you have those false breakouts, when we're looking at the way in which supply and demand works. So that would be the two things that the bulls really need to pay attention to at this moment in time. But when we look at things on a technical standpoint, they've broken over the major hurdle. They have one more smaller resistance level up in here. All of the moving averages are aligned properly. We're not in overbought territory. The MACD is crossing over to positive. This looks pretty good here for the bulls. The only thing that you could really say is that we have kind of gone that straight up route. There hasn't really been a dip, so to speak, a substantial dip in a move, which is normal, right? Usually you get kind of a 2 steps forward, 1 step back, 2 step forward pattern where you would see something like this play out, which we have not had. So that has put some people kind of in that cautious mode. But again, when we just look at the technicals here, everything looks good. Let's look at the Nasdaq. The Nasdaq, we have the same thing. 10 over the 20, over the 50, over the 200. They're all aligned. They're all moving to the upside. We're above that major resistance zone. We're almost at those all-time highs. We're at that 2.5% or so to speak. Yesterday's candle wasn't necessarily the greatest looking candle on the Nasdaq. That does kind of look like a shooting star candle. This is over that 70 RSI zone, so it has been more overbought, so to speak, than the S&P 500. Again, the next resistance zone really is at that 7,700. Same comments apply in terms of that acting as a potential double top or having a little false breakout there. based on what we just talked about. And we take a look in at the Dow. The Dow has a bit more to run, about 2.5%. So, I mean, all the indexes are about 2.5%, except for the last one. And that, of course, would be the Russell. We'll get into that in just a second. But again, moving averages aligned properly, 10 over the 20, over the 50, over the 200. We have a nice ascending triangle pattern here over the Dow. This looks good as well on a technical standpoint. MACD's crossover in positive territory, and we're below that 70 zone, so we still have room to run here to the upside. Now, the Russell, on the other hand, has been and was the leader to the downside last year, and has been again, underneath the 200-day moving average. Still hasn't closed over it yet. So a very different look out of the Russell 2000 and the rest of the indexes. And this again is one of those areas of concern when we think about what the mid and small caps are. They are a gauge on risk. If you believe everything is going to go well, you're usually more willing to put your capital into higher beta names, riskier asset classes, because the upside essentially is bigger. And we still have not seen the Russell performing or get back up over that 200-day moving average. Now the rest of the moving averages are aligned. It's over the 10. It's over the 20 is over the 10, which is over the 50. So it's actually, we need to see another day or two of upward movement, and then we would have the 10 over the 20 over the 50. The MACD is crossover in positive territory. And one way that you could look at the Russell 2000 if you wanted to is this is a giant bull flag. That technically is what it does look like. But of course, we've got major resistance in that 200-day moving average here. So the trigger, if you were looking at this, would be that 1600 level. For that next potential move here to the upside. And off of its highs, it's 12%, 11.5%, 12% off of its highs. So a very different chart of the Russell than we have of the rest of the U.S. indexes. I hope you found today's video useful and informative. As always, I hope you guys have yourselves a fantastic week. Mike Tedeschi over at Perspective Wealth Planning. Hope you guys have yourself a good one.